I wanted to briefly discuss the latest news from the OECD. Of course, this is one of the global economic bodies that is very similar in power and quote-unquote prestige and influence as the World Bank and the IMF. Some would even argue more influential. Nonetheless, as you can see, the OECD recently advised the European Central Bank to begin buying Eurozone assets, government debt from various European Union nations. Now, this, of course, is against the EU treaty. However, there are many ways that the ECB could go about doing this. And I predict it's going to happen if they wanted to have a chance in saving the EU. Now, my view on the EU is a little bit different. I think it's a disaster. I've talked about this, I've written about it several years ago, and randomly throughout since that time. I reminded investors of the case that I made. I wrote a piece, I believe, in 2009 that discussed why the EU would fail. And I used a very simple economic argument, and I actually used the case of Germany versus Greece. And of course, that was prior to the time when Greece really collapsed. And actually, I used that analogy several years ago, right when the EU had formed, or the European Monetary Union, that is. Now, recently, you may have heard that the ECB also slashed interest rates to 25 basis points. This is also something that I stressed more than 2 years ago, nearly 3 years ago. I wrote about this, and I was pretty shocked that the ECB was not being more aggressive in cutting interest rates. I mentioned it a few times thereafter, all the way up through the 2012 mid-year global economic analysis, and then I pretty much just kind of set it aside because the ECB just basically doesn't understand what's going on. If you think that the clowns in Washington are confused and clueless, I can tell you that the leadership at the ECB and other government bodies in Europe are much more clueless. Now, the first major warning that I provided in detail was in the Intelligent Investor nearly 3 years ago. This warning was a fairly detailed presentation discussing that there would be a long deflationary period in Europe. And I laid out the case based upon many things. The point was that obviously Europe has a lot of challenges ahead of it, but at the very least, one of the things they must do now, or back then, was to be more aggressive in slashing interest rates. And they, of course, did not do that. And I'll go over some of the data so you can see back at that time, the officials, of course, didn't think there would be a problem because we were still benefiting from the global stimulus that was passed in 2009 across the globe. This is the issue, and you can see Europe's deflationary future, page 14. Now, this issue, it turned out to be a very critical issue because it also discussed the beginning of the commodities bubble correction. And this is precisely when it began. It would turn out that we nailed it. Before I go on and show you a little bit about Europe's deflationary future, let me review the commodities section. So you can see here, I begin discussing how I felt that the commodities bubble was going to correct. And I show different levels here. And of course, since that time, the research we have gone through and provided monthly forecasts, they've been very, very accurate. But of course, this is the most important section, the most important part of this particular newsletter issue for this discussion. As you can see, I summarize many things, many facts about the EU versus the US. Those of you who read America's Financial Apocalypse recall that I discussed the underfunded pension problem extensively. Since that time, we've had a collapse in interest rates throughout the advanced world, and that has, of course, contributed to the underfunded state of pensions, which you're not hearing about. And I've continued to discuss that because it's a very critical issue that no one is discussing, but it is going to have a very large cumulative impact on savers. Now, in the 2012 mid-year global economic analysis, I also showed excerpts of several reports discussing what I felt was going to be a long deflationary period for the European region. This report, by the way, is currently available for free for those who sign up for website membership. This report was released originally about, I think, $400 or $500 price tag. It's 300 pages, and I can guarantee you it's the single most comprehensive and informative piece on what's going on, still even today, a year and a half later. This is a very, very extensive report, and actually it's a book. It's as close to America's Financial Apocalypse Part 2 as you're ever going to see. And actually this is, of course, a global treatment. So I would encourage all of you to not only get a hold of this report, and the best way, of course, is to sign up for membership, but also for those of you who have this, and of course all subscribers to The Intelligent Investor should have this as well. If you're a new subscriber, you should receive this. As a matter of fact, all subscribers to Dividend Gems and Market Forecaster should have this, current subscribers. Don't think that because this says 2012 mid-year global economic analysis that a 2013 global economic analysis will make this particular report obsolete. It's just simply not true. Probably not going to release a report of this substantial nature in a few years from now. So keep in mind, it's a very, very, very critical report. And I can tell you that much of this report will remain very, very relevant for several years to come. You can see here page 96. These are excerpts from the October 2011 Intelligent Investor. And at that time, I had identified that a recession in the EU was approaching. And I was ahead of the curve. And so you can see here that I recommend specifically that the EU immediately acts to lower interest rates by 100 basis points. And they did not do that. So let's have a look now at interest rates, historical interest rates. I felt that interest rates should come down to about 25 or 50 basis points in the EU, and they didn't do that. So let's have a look now at some of the historical data. So you can see here that during that time, that report was released in October 2011, the interest rates from the ECB were approximately 1.5%. So I called for a collapse in interest rates of all the way down to 50 basis points, and that just simply didn't happen. Now, the ECB did lower rates around that time over the next couple of months, over the next few months, to 1%, where they remained throughout mid-2012. It just wasn't enough, though. You can see that since I called for an immediate collapse in interest rates down to 50 to 25 basis points in late 2011, it just didn't happen. Instead, it's taken the ECB 2 years to do that. It's just completely ridiculous. And throughout that time, the economy has continued to get worse. Regardless of what you've heard, and of course I have continued to report on this, you're hearing, even now you've heard recently over the past couple of months that Europe has moved out of its recession. That's just a bunch of baloney. The employment situation is getting worse. And so it's really too little too late. And as a result of that, I think Europe has really dug itself into a pretty big ditch now, such that the ECB is going to have to buy assets of several European nations. That's really the only chance that they have. Of course, that's a very risky maneuver because the ECB is not the Federal Reserve. The Federal Reserve can print virtually unlimited amounts of currency for a variety of reasons. I'm not going to get into that, but it's a little bit different in Europe. The bottom line is they don't have the universal currency, the world's reserve currency. They don't have the petrodollar, right? Their currency is not linked to commodities. But nevertheless, they can do this if they want to. They can buy these assets. The OECD has also called for the ECB to engage in quantitative easing. Now, we've seen how that's been successful for Japan. It hasn't really been successful for the U.S. economy. It has helped the financial system in the U.S., no doubt about that. And that component of the financial sector has, of course, boosted the U.S. stock market performance, but just from the financial sector. Now, of course, there's also been an indirect impact in improving the risk premium. But all that aside, if you look at Japan, of course, Japan's quantitative easing is a little bit different than the U.S.'s. And the bottom line is that Japan's inflation target, Japan's widening budget deficit has helped their labor market. It's improved their economy. Is it risky for Japan? Of course it's risky. Is the risk worth it? Yes, it is. And so far, it's proved to be very successful. The question becomes, of course, at what point do they trail off and end this quantitative easing in Japan? Now, the other issue I wanted to mention is something I have not discussed before. It goes back to this Reinhardt and Rogoff. These are the guys that came out and said, hey, you know, when you have a debt to GDP ratio above 90%, your economy basically implodes. It begins to deteriorate very rapidly. It's been found that their research was basically fraud. There's no way they could have mistakenly left out the data like they did. It's just impossible. It was basically fraud. And if you look back at, you know, who's behind all that, that's another issue as well. But if you want to investigate that, you have the Koch brothers and the Koch movement, all these guys behind the, you know, end the deficit and all that crap. These guys are funding all these clowns. Now, if you look into that whole realm, which I'm not going to get into, this is where you see all these Peter Schiff guys, the Kyle Bass morons, all these clowns talking about how, you know, too much debt is going to destroy the economy. Debt is not good, but when you have these people talking about these things, they really don't know what they're talking about, and they've been proven now because their premise was based upon the Reinhardt and Rogoff's paper, right? This whole austerity movement has been based on Reinhardt and Rogoff. Complete frauds, these guys are. Frauds! And as a result of their fraudulent research, their fraudulent publications, has caused many nations in Europe to have a much worse economy, a much worse recession. Clearly, it put the UK into recession about a year and a half ago. So, guys, it's one thing I just wanted to go into. Maybe if I get a chance at some point later on, I'll talk more about it in detail. I don't really focus on these things so much because it's kind of a soap opera. It's kind of a drama, right? And it's just not high yield. It's the type of thing that all these clowns and people in the media, they want to focus on. I focus on forecasting and pure results, right? So I try not to infest my subscribers, my clients, with soap opera baloney so much, but I did want to mention that just briefly. So getting back to interest rates in Europe, you can see that they've responded too little too late. And if they had taken my advice, I think the EU would be in much better shape. Now let's take a look at the historical inflation, because that, of course, is connected to interest rate. So this is a chart since 2010 of Euro area inflation. Now recall that when I wrote this report, the deflationary future of Europe, it was once again February 2011, about right here. And so you can see that, you know, the inflation was increasing. It was in an increasing trend when I wrote this. I wasn't worried about the past several months. This was all from the stimulus, right? I wasn't looking at that. I was looking at the bigger picture in the future. And you can see now the inflation rate has collapsed. It's approaching a deflationary situation in Europe. What does that mean? That means that Europe needs to target a higher inflation rate. They need to encourage inflation to stay out of deflation. Now, I'm not going to get into the whole deflation-inflation debate. I have discussed this before, and that is that I don't feel that deflation is that bad as the economic establishment would have you believe. According to the economists out there that run everything, deflation is a complete disaster. I don't believe that. That's only if you buy into this whole mentality that we have to keep continuing to increase economic growth. It's kind of funny, you know, the same establishment that's out there talking about global warming and our need to reduce emissions because of global warming, these are the same crooks that are telling us we need to maximize economic growth, right? Well, the best way to reduce emissions is to stop pushing economic growth so aggressively so that we don't have these credit bubbles, right? We have a natural inflationary component in our economy throughout the globe, and that's because there's this constant push by central banks to leverage the economy to maximize economic growth, right? That in itself actually contributes to unnecessary carbon emissions. It's funny you don't hear about that. Why not? Best way to reduce carbon emissions is to stop pushing all this so-called economic growth. And of course, this so-called economic growth primarily benefits the corporations and the wealthy individuals. It does not benefit the working class, the middle class, to nearly the same extent as the corporations, corporate profits, and the wealthy individuals. And that's the reality that you're not hearing. So it's okay to push the so-called economic growth to maximize it so that we can push profits forward, right? Meanwhile, continuing to enslave more individuals throughout the globe through so-called free market economics. This is all causing massive emissions. At what expense? At what cost? At the cost of improving the living standards of the masses? Of course not. It's reducing the living standards. It's the corporations and the wealthy individuals who are benefiting primarily. You don't hear about this. Nonetheless, all that aside, you can see that the inflation has collapsed over the past 2 years in the European region. And so, obviously, if the interest rates were smashed, like I had advised a couple of years ago, you wouldn't have seen this. But now, you can see, especially over the past couple of months, there's been a very large decline in inflation. We are approaching a deflationary situation in Europe. Now, you've heard over the past few months that Europe is getting better. They've pulled out of the recession. Once again, I've written about this. I said that's hogwash. You've heard the same thing about China. Well, recently now, even the establishment has talked about how the European economy and the Chinese economy have really faltered. They have not improved like was previously discussed. And that goes back to, once again, you have to look at trends. You have to look at multiple data sets, multiple data points. You can't just look at monthly data and think that you can extrapolate that. That's all I wanted to say about the EU, and there will be more coming shortly.